Welcome back to our series on IND AS 105.
So what's IND AS 105 all about anyway? Let's jump right in and do a quick recap. We're going to break down the three main areas that this really important accounting standard covers.
All right, a good way to think about INDS 105 is to imagine it's built on three big pillars, and each one of these pillars handles a very specific situation a company might find itself in.
So pillar number one is all about individual non-current assets that are held for sale. Think of things like a single piece of machinery or maybe an office building. These are long-term assets, right? But the company's decided, hey, we're not going to use this anymore. Instead, they're planning to sell it. The whole point is that they're going to get their money back from a sale, not from using it day to day.
Okay, moving on to the second pillar. This one kind of zooms out a bit. It covers what we call disposal groups held for sale. Now, this is where a company isn't just selling one thing. They're planning to sell a whole bunch of assets, and sometimes even the liabilities that go with them, all in a single deal. A perfect example? Selling an entire factory. You're not just selling the building. You're selling the machinery, the inventory, the whole shebang.
And finally, we have pillar number 3, discontinued operations. This is a big one. We're not talking about selling off a spare machine here. This is about a major strategic decision. It's when a company decides to shut down a whole chunk of its business. Like, say, getting rid of an entire product line or pulling out of a country altogether.
Okay, so here's the deal. A company can't just say it's going to sell something and have it fall under IND AS 105. No way. It has to meet two really strict mandatory criteria. Let's call them the 2 golden rules you absolutely have to follow.
And when I say mandatory, I mean non-negotiable. These are the gatekeepers. To make it easy to remember, just think of the mnemonics ISPC and HP. We'll break down what those mean right now.
All right, so ISPC stands for Available for Immediate Sale in its Present Condition. The key words here are immediate and present condition. This means the asset has to be ready to go right now, as is. It's not about a plan to fix it up and sell it later. It's about being able to hand over the keys to a buyer today without any major delays. And the second rule, HP or highly probable, what does that even mean? Well, it's not just wishful thinking. It's got to be backed up by real action. We're talking about management being fully committed to a plan to sell. They've got to be actively looking for a buyer. The price needs to be realistic, and this is a big one, the sale is expected to happen within 1 year. Basically, it's a very high bar to clear. The sale has to be almost a sure thing, not just a maybe.
Okay, last thing for this recap, and it's a super important point. We need to talk about what this standard actually does for those pillars we just covered. Because you see, it kind of wears 2 different hats. So check this out. For the first 2 pillars, those individual assets and the disposal groups held for sale, IND AS 105 is all about measurement. It's a measurement standard. It tells accountants exactly how to value those assets on the financial statements. But when it comes to that third pillar, discontinued operations, it's not about measurement at all. It's a presentation and disclosure standard. It's telling you how you need to show this information in your reports. And that difference is absolutely crucial, right? It helps everyone reading the financials understand the massive difference between selling off a single asset and shutting down a whole part of the business. Now that's done. Before you go next part, please refer to your textbook thoroughly. It's very important for exams, and write down some notes to make your revisions quicker. See you in the next part.